Hello all. Let's continue now with the net present value analysis, cash flow analysis. This particular section is an example from your textbook, and what I want to talk about here is that this is an example that discusses in more detail, but what comes out of it is how to treat the net working capital when it extends beyond many years. This example is in your textbook, but it runs through like 4 to 5 pages. I'm going to condense it all into one nice table. And the reason I like to do that is also when you do your capital budgeting project, that's exactly how you can present the table. You don't need to go into multiple exhibits in order to just come to a conclusion. Okay, so what happens in this project is it's a Majestic mulch and compost company that is designing a new set of power tools, and they require an investment of $800,000. They predict they can receive the following cash flows for 8 years. Okay, so I'm sorry, it's a power mulching tools. So the details are as follows. Initial investment, $800,000. Let me make sure I'm still recording. Has salvage value of 20% or $160,000. There's an annual fixed cost of $25,000. We're given the tax rate of 34%. The discount rate or cost of capital is 15%, and the variable cost per unit is $60. Now the sales, as you're given first in units, and the way it's going to increase initially from 3,000 units to 6,500 units, and thereafter, presumably as the competition gets in, the units are going to come down till 3,000 units over the 8-year period. The price is going to be $120 for the first 3 years and $110 for the remaining years, 4 to 8, which is 5 years remaining. Now, the only catch here is that the net working capital which we did, there is one for 20,000 in year 0, but thereafter, they have to maintain a net working capital of minimum of 15% of sales. Now, the depreciation they follow is a 7-year depreciation schedule, and this is the only time we'll be doing the depreciation using MACRS, but at least it'll give you an idea of how it works. Okay, so moving on, let's see how we first thing we have to do is to calculate the revenues, and we are given the units and the price. So for example, in the first year, the number of units is 3,000 multiplied by 120 is 360,000. The variable cost is 60 times 300,000 units is 180. For year 8, we are back down to 3,000 units. So again, it's 180,000 units. Okay, so if you go back, you'll see it starts at 3,000 and ends at 3,000 units. Now the depreciation schedule, let me show it to you in the next page. As you can see over here, the depreciation schedule here under 7-year MACRS is 14.29% first year, 24.49%, then it starts coming down till 4.45%. This is as required by the IRS, okay? So in the first year, then it'll just be 2.1429% times the 800,000, and that's what you get. In year 8, it's 0.0445 times 800,000, so it's 35,000. Now, let's go and do the full cash flow analysis. So if you looked at this, and I'll try to increase it a little bit more. Yeah, here we go. So in year 1, 3,000 units times price gives you the revenue. This should be $60. So variable cost is $60 times 3,000 units is 180,000. Fixed cost of 25,000, and this is the depreciation. The first year is based on 14.29%. We subtract all that, we get the pre-tax profit. We take away the taxes. This is our profit. So we add back the depreciation, and lo and for our cash flow is $141,168 80. So we do that for all the years till this point. So that's our cash flow, and it's a regular way to do it. We can use the formula even to get that number. But what is interesting is that the cash flows is the net working capital. As you can recall, first year we have a 20,000 in year 0 working capital. Our cost of equipment was 800, so the total is 820,000. But it also said that the minimum you needed was 15% of sales. So in the first year, our sales was 360,000. 15% of that is 54,000. So that means our working capital had to be 54,000. So that means we'll have to dish out another 34,000 in addition to the 20,000 to make it come to 54,000. So that will be subtracted from our cash flow because that's money set aside to make sure that we have the investments for accounts receivable, inventory, etc. Same thing goes to the following. 15% of sales in year 2 is 90,000. That means we already have 54,000 in net working capital, so we have to subtract another 36,000. Continues the same way till year 3, and then in year 4, the sales start petering out. Remember, the price also comes to 110. So our overall sales at 15% of sales is 107,000. So now we need less working capital, so we'll start recovering our working capital. So the difference between these two is 750. Same thing happens, 15% of sales in year 5 is 99,000. That means we need less working capital, so we'll start recovering our working capital. In the last year, in year 8, what we're going to do is we're going to make sure that we recover all of it. So all these negative numbers that we dished out and kept for working capital, 20, 34, 36, and 18, a maximum of 108, we have to make sure that these things also total up to 108. So the last one is a residual number. Whatever working capital we didn't capture, we'll capture it in this year. Finally, we have a salvage value. As we told you, the salvage value was 160,000, but taking away taxes, we are left with 105,600. So in this example, we have cash flows, but we also have net cash flows. And the net cash flow is 820 out the first year, and these are the cash flows coming in. After that, it's straightforward. We do the net present value at 15%, and we get 65,487, which means we will go ahead with the project. So it's very straightforward, and instead of doing it all in 4 pages, we all got it down in one exhibit, but the same analysis as we've done previously. Okay. Now we're going to move to a slightly different project. This is just the repeat of what I said. And this project talks about unequal lives. So what it means is as follows, that sometimes when you're evaluating 2 projects, you may have projects that have different lives. And then a question comes about, is it right to compare those 2 projects as being the same because of the fact that one lasts longer than the other? So I'm just going to do an example from this, which is very simple, but let's take a look. If you take a look at the PowerPoint, in this case, I just want to check these. Meeting controls, what is that? Okay, so what we have here is the following. Let's say we are comparing 2 different machines we're planning to buy. One of them has a cash outflow of 320,000 and then a cash inflow of 160,000 for 3 years. The next one is negative 420,000, and then we have a cash inflow of 120,000 for the next 6 years. The net present value is, we calculated 10% is as follows. It's 77,000 for the first project and 102,000 for the second project. So obviously, if you're just using the net present value criteria, we'd say, let's take this machine. But there's a problem. Are we actually comparing the same project? Because this project only lasts 3 years. So why don't we, I mean, we need to adjust that, because technically we should look and see if we can replace this one and last till 6 years and then make an effective comparison. So one of the things we can do is to say, the simplest thing we can do to say is, listen, why don't we just assume that, I'm just going to do that here. Hold on, I'm just trying to get my thing over here. And say, listen, why don't we assume that we continue to replace the same machine here? And we'll assume everything remains the same. It's not going to be a realistic assumption, but at least close to it. And then we can say, all right, then now we are comparing apples to apples at this point. So if we go to the next page, we'll see what happens. Because we are replacing it the same equipment, the net present value of these was calculated at 77,896.32. So to calculate this additional project, we get these here, and this also will be 77,896.32. And if you bring that back, it'll turn out to be worth 58,524.66. So if we add them up, it's 136,420. So in other words, the present value of this, if this project was repeated twice, is not 77, but 136,420, which is greater than this project. So in reality, if we have projects with unequal lives, we must have some methodology to combine it so that we are comparing it with at least the same lives of this project. It turns out though, because one of the things that could happen is, what if you had a project that is, let's say, 7 years, and one project is 11 years. Then in order to find the common ground, because these are two prime numbers, we'll have to go to year 77. So we'd have to repeat it so many times to get to a common period, and then say we're effectively comparing two projects of the same lives. So, but there is an easier way. It turns out that we have a way of annualizing this net present values. In other words, we get an annualized net present value. And the way we do it is, we take the net present and we divide it by the present value annuity factor. And when we do that, so N and R, we are actually transforming the net present value into an annualized net present value. So let's do an example here. Remember the project for the 3 years was 77,896.22. Well, if I divide it by the present value annuity factor, n equal to 3, r equal to 10, then let's see how I get that number. That number you get by doing the following. You put 1 is my payment, 3 is my n, 10 is my interest per year, 0 is my future value, compute present value. That's the annuity formula, and that's an easy way to get that, and it'll equal to 2.4869. So I'm going to pause the. So I just put this, I got this formula back from your chapter 6 notes, and that this annuity factor is this particular equation here, the 1 minus 101 plus r to the power t over r. It's the present value annuity factor formula. If we did that, we'd get 2.4869. So you can either use the formula or you can use the calculator. But what it says is, for this 3-year project, your annualized net present value, which we call equivalent annual net present value, is 31,323. So we can do the same thing. Oh, I do have the formula over here, so it's given over here. this is the same as this formula. Remember, it's minus n at this point. So for the second project, that was, remember, 6 years. We got the net present value is 10261.28. Well, let's divide it by the present value annuity factor. So what we'll have to do is to do 1 is my payment. In this case, 6 is the n. 10 is the interest per year. 0 is the future value. Compute present value, and it gives us this 4.3553. So if you divide that, then on an annualized basis, our profit is 23,564. So this equalizes the life because now everything is on an annual basis. So obviously in that case, you'll say choose project A because on an annualized basis, it's a higher net present value. Just to refresh your memory, the way this formula, the formula works by dividing is that it assumes we replaces this machine to infinity. So the 3-year project is replaced to infinity, the 6-year is replaced as infinity, and we get the present value on an annualized basis. So, and that is used quite often now for projects of unequal size. Okay. I'm going to do an example that's in your book that uses this. Now here it's slightly different because it's not a net present value, but just a cost. So it's an equivalent annual cost. Okay. So here we go. There's a filtration system that costs 1.1 million to install and 60,000 to operate. The other system that's being considered is a precipitation system, which costs 1.9 million. A little bit more, but less operating costs, 10,000 to operate annually, and that will last 8 years. So based on a cost basis, which is to try and minimize, which project should we use at this thing? Use straight line depreciation, tax rate is 34, and discount rate is equal. So let's start with the first filtration system. It says it's 1.1 million. It's for 5 years. So it costs negative 1,100,000. Excuse me. And it's for 5 years. So for this, since we are not given the after-tax cash flows, we'll still have to calculate the cash flow. So let's see what the cash flow is. Remember the formula, it's revenue minus variable costs minus depreciation. Take away the taxes and add back the depreciation. Now here we have no revenue, so this is 0, but we do have the variable costs, 60,000. And then we have depreciation. So what's the depreciation? Well, it's 1,100,000 divided by 5. Let me quickly take a peek what that number is. That number is, I'm going to shut this off. That number is $220,000. So negative $220,000. Take away the tax rate, and I'm going to check again, making sure I don't make a mistake. The tax rate, 0.34. Then I add back the depreciation, and I get 35,200. So 35,200, 35,200, 35,200. Now you might ask and say, well, how do they get positive cash flows when all they have is operating costs? Well, you can take a guess. Yes, it's the depreciation. It allows the company to depreciate 224,000, and at 34,000, that amounts to around, to be precise, it amounts to be 220,000 times 0.34 is about 74,800 in reduced taxes for the company. And that overwhelms the 60,000 actual variable costs. So that's for that particular project. Now, when I do the net present value, so if I did net present value for this, which how would I do it? I'd say cash flow 0 is negative 1,100,000. cash flow 1 is 35,200, and how many times? It'll be 5 NPV, and the interest or the discount rate in this example is 12%. Compute, and I will get negative 973. Just going to look here, 111.88. But this is a 5-year project, and remember, we're going to be comparing it to an 8-year project. So the equivalent annual, now we don't use NPV because, well, we could use NPV, but the book uses equivalent annual cost, so it doesn't matter if you use equivalent annual, is we need to divide this by the present value annuity factor, N is equal to 5, and R is equal to 12. So if I did 1 is my payment, 5 is my N, 12 is my interest per year, 0 is future value, compute present value, then I will get this equal to negative 973,111.88 divided by, it'll be 3.6048. 3.6048. That means on an annualized cost, it'll be 269,948. 269,948.92. So over the 5-year period, but assuming it's replaced infinitely, my annual cost on this machine is negative 269,948. What about the next project? Well, that one was 8 years, if you recall, and it cost 1,900,000. So it'll be 1, 2, 3, 4, 5, 6, 7, 8. The cash flows on that is 0 minus, remember, it was 10,000 was a variable cost. And now we need to find our depreciation. Our depreciation is 1,900,000 divided by 8. Let me just take a peek. If you did that divided by 8, it'd be 237,500. So you subtract 237,500. Take away the taxes, add back 237,500, and your cash flows will turn out to be 74,150. 74,150, 74,150. I'm not going to put it all over. 50, 74,150. If you did the net present value at 12%, that is, you use this 1,900 for your C0, 74,150, 8 years, your net present value will turn out to be 1,531,649. 1,531,649 and 50 cents. However, that's not adjusted for the years because this is 8 years. So obviously it'll have more cost. But if we annualize it, then to do that, we divide this by PVA, where N is equal to 8, R is equal to 12. How do we get this number? Well, 1 is my payment, 8 is my N, 12 is my interest per year, 0 is future value, compute present value, and lo and presto, I will get 4.9676. 676. So to get the equivalent annual cost, I'll divide this 1,531,649.50 with 4.9676, and I will get 308, 327, 308, 327.87. And I'm going to compare this with the other plant, which was 269,948. So obviously I'll choose the 5-year project. So since the project of filtration is lower than EAC, which is the precipitation, I will choose project F at this point. So we've done 2 examples of unequal lives. So that's important that you remember that. So once you find the net present value, then what you'll do is you'll just divide it by the PVA, and then you'll be comparing apples to apples. If between the 2 projects, they have different lives. If they have the same lives, then you don't have to do it at that point, okay? Now, the last part of this problem, of this chapter problem, is what we call setting the bid price. And here, this is a methodology that we use when you bid for projects. As you know, many firms will send out bids if they're going to be buying something. The government does that a lot. And there's, how do we use the net present value analysis to do that? It's actually very simple. There's a little bit of extra work to be done, but we'll give you a good idea once we do this particular example, okay? So in this particular example, the local municipality, let's say, has put out a bid. They want to supply a company to supply 5 modified trucks. Think of them as the garbage trucks. For a period of only 4 years, so a total of 20 trucks. So 5 trucks a year for 4 years. We have to figure out a way to say, what's the minimum we should bid for this? That's so the first thing we need to know is, of course, what are all the costs involved in getting this done? So let's say here's some numbers we have. In order to take this project, we'll have to buy some platforms. And let's say it costs $10,000 per year. Let's say we have to lease it. $10,000 per truck per year, and so we need 5 trucks, so we need to have these 5 platforms leased. Then we also have to lease some space. Let's say additional space, it's $4,000 per truck, so it's $20,000. And then there's additional space for administrative work, so it's $24,000. This is, by the way, all from your textbook. Okay, so the total amount per year we'll need, think of it as variable cost, is $94,000. Now I'm going to give you some more information. I need to buy an equipment worth $60,000. That equipment after 4 years can be sold for $5,000. I'll also need net working capital. My tax rate is 39. My cost of capital is 20. I need a high because this is government project. You better demand a higher rate of return, and you're going to do the straight line. So the first thing we want to do is to actually say, what's the minimum cash flow I need before I determine what my price is, so that it covers all these costs that I have. Okay, not the variable costs, but just all the fixed costs that we know will take place. Actually, that turns out to be not that difficult to do. We know that initially we have to put out $60,000 for new equipment. We need to put $40,000 for working capital, so that means it's $100,000 out. We also know what will come at the end. The $40,000 net working capital will be recovered. There's a salvage value of $5,000, but once I take away the taxes, because it'll be, the book value will be 0 at that point, times 61 will give me 3,400. So this makes it easy, because then what I can do, I can say, I do negative 100,000 is my present value. I have 43,050 as my future value. 4 is my N, and 20 is my I. Compute payments. So out will shoot 3609.17. So that means if I can get net after all 30.609 17 as cash flows, then I should be okay. I will definitely earn the 20% return that I have. I'll dish out this, I'll get these, I'll get that, and my net present value will equal to 0 at this point. So I will have perfect 20% return. So now the question is, how do you make sure that 360917 is this? So this is what I'm going to do now. I will say, here's what we'll have to do. We'll have to say sales minus the variable cost. And is there a fixed cost in this one? Some of the projects have fixed costs. There is no fixed cost in here. Sales minus variable costs minus depreciation. You get the earnings before taxes. You take away the taxes, you get net income, add back the depreciation, and that should equal to 3609.17. Correct? Is it 17? Yes. Or you can write it the other way. That is, CF is equal to sales minus variable costs, sales minus variable cost minus depreciation, take away the taxes, add back the depreciation. This we know it should be 3609.17. So now I should be able to calculate the minimum sales or revenues that I have to get in order to get this cash flow. So variable cost we already said was 94,000. Equipment, depreciation, well, we know the equipment was 60,000, 4 years, so it'll be 15,000. So that's what your depreciation will be. So minus 15,000. Tax rate was 39, so 1 minus 0.39 is 61. And then we add back the depreciation. So let's solve for S. Let me bring this 15,000 here. So that'll be 30,609.17 minus 15,000. This is going to be, let me just do it the long way first time. Minus 94 plus 15 is 104 and 109,000 times 0.61. Excuse me. 3609.17 minus 15,000 is 15,609.17 is, let me open this bracket, 0.61s minus, I'll multiply this with this, store this, 109,000 times 0.61 is 66,490. Bring this over here, this one, which means I'll add it, plus 3 equals 7. It'll be 82,099.17 is equal to 0.61 S. So S is equal to 82,099.17 divided by 0.61. Should be 134,588.80. Let's double check, make sure I haven't made a mistake. It's 134,588.80. So in other words, if I have 134,588.80, I take away my variable costs, I take away my depreciation, then I get my EBT, take away the taxes, add back, I'll end up with exactly 34,689. So all I have to do is say, if I can get 134,588.80, then I'll be okay, but there are 5 trucks, so I'll divide this by 5. And so the minimum I need to bid is 26,917.76. So that's the minimum bid price that you need per truck. So as you can see, the net present value analysis is very flexible. We can apply it to different types of projects. Okay, so this is a simple example. So for this chapter, you'll basically either have a regular net present value analysis, you'll have a replacement analysis, you will have an unequal analysis, and then a bidding price analysis. So you do need to know all four of them at this point. Okay. Thank you. Now we are done with chapter 10. You'll have to do additional problems in your assignments, and then you should be okay. Thanks.